Hi, my name's Brody. In this short video, I'll be running through the Statham case. It concerns a distinction between the mere realisation of an asset and the carrying out of a business or profit-making undertaking or scheme in the context of subdivided property. This is otherwise broadly known as the question of revenue versus capital. Brief facts of the case are as follows. Mr. Aderman, the owner, acquired 270 acres of rural land from his late father in 1970. He wanted to use this land for farming. In 1976, he sold a parcel of the land to his sister and brother-in-law with the intentions to enter a partnership with them and begin raising cattle on the property. These plans fell through due to many reasons, but the declining health of Mr. Aderman from 1977 to 1979 led to the decision to sell the land instead. Mr. Aderman died in 1980, before the first plan of subdivision was registered with the local council. It's important to note that the owners would have been fine to sell off the land then and there, but the inability to find a suitable buyer led to them to see the subdivision to fruition. The Commissioner adjusted the assessable income of Mr. Aderman's deceased estate for the 1982 year by $62,884, which was the proceeds from lots sold during that year. His justification for doing so being that the profit from the sale of the lots was assessable under either Section 25A1 or Section 26A of the Income Tax Assessment Act 1936. He was of this belief primarily because, in his opinion, the subdivision and sale of the land took place by means of a profit-developing business or in the carrying on or carrying out of a profit-making undertaking or scheme. The trustees of the deceased estate took the matter first to the Administrative Appeals Tribunal, who concluded in favour of the Commissioner's view. They found that the moment the estate ceased their plan to use the land for grazing and began plans to subdivide was the moment in which a business of land development began. This view was heavily inspired by what was held in the Whitford's Beach case, where a change in intended use for which land is held led to the beginning of a property development business. If not a business, the AAT argued that the substantial profit that arose gave the subdivision the appearance of a profit-making undertaking or scheme. The trustees were still not happy with his conclusion and appealed to the full federal court to decide the matter. The full federal court found the AAT to have come to a mistaken conclusion, stating that the change of intent is not equivocal to the beginning of a new business, and that the favourability of a transaction from the position of the taxpayer does not necessarily mean that there is a profit-making undertaking or scheme taking place. The full federal court established what they believed was necessary to distinguish between the mere realisation of an asset and the carrying on of a business or profit-making undertaking or scheme. This being whether a business itself is actually taking place. It was concluded by the full federal court that the facts surrounding the subdivision exhibited few of the hallmarks of business enterprise which are necessary to support the Commissioner's argument that a business or scheme is being carried on. They found the following facts to be relevant. The owners were first content to sell all of the land, but were unable to do so. No money was borrowed to undertake the development. The owners relied on the council to carry out roadworks, electricity, and sewerage works. The owners did not erect any buildings on the land. There was no business organisation established for the purpose of the subdivision. The owners maintained their respective employment throughout the subdivision, and the land was not advertised by the owners, but simply listed with local real estate agents. Taking these facts into consideration, it was held that the sale was the mere realisation of a capital asset by most advantageous means. The Commissioner was called to rescind his assessment. These hallmarks, referred to in the case, have been expanded on and developed into a list of factors that can indicate whether a business or profit-making undertaking or scheme is being carried on if a combination are satisfied. I will be referring to these simply as the Statham factors. The list is as follows. There is a change of purpose for which the land is held. Additional land is acquired to be added to the original parcel of land. The parcel of land is brought into account as a business asset. There's a coherent plan for the subdivision of land. There is a business organisation, for example, a manager, office, or letterhead. Borrowed funds finance the acquisition or subdivision, and the interest on such money borrowed is claimed as a business expense or deduction. There is a level of development of the land undertaken beyond the bare minimum to secure council approval for subdivision, and buildings have been erected on the land. I know you're all raring to hear whether the Statham factors are still relevant. Well, in the modern day, these factors from the Statham case may still be relevant to subdivisions of pre-CGT land that may be taxable under Section 25A of the 36 Act, targeting businesses and profit-making undertakings and schemes. This is rather important as, you may know, pre-CGT capital receipts are tax-free if they're not captured by existing statutory provisions such as Section 25A. This means that a dispute of revenue versus capital would likely have a very black and white effect. You either pay tax on the profit as ordinary income, or you don't pay any tax at all, making the principles of Statham quite influential to the taxation of the transaction. Compare that to a post-CGT assessment under Section 1515 of the 1997 Act. Income tax may be paid on the profit regardless of its classification, as either ordinary income or statutory income capital gains. Of course, CGT discounts and concessions may be allowed under a capital classification, potentially reducing the part of the capital gain which forms assessable income. So, it is still more desirable than a revenue classification. Statham is not relevant where land is otherwise or better described as trading stock. Land can be treated as trading stock if it's held for the purpose of resale and a business activity which involves dealing with land has commenced. Such business activities include land development, subdivision, and sale. Many property developments are captured by this treatment, rendering the application of a revenue versus capital distinction unnecessary, as profits on the sale of trading stock are usually ordinary assessable income to the taxpayer anyway. Modern tax practitioners with clients who are subdividing and selling pre-CGT land will engage with the principles of the Statham case the most. The factors will be extremely important to their client's tax position, as they can mean the difference between paying tax and paying no tax. Engagement with the Statham case is also important where pre-CGT land is subdivided and buildings are subsequently constructed on the lots and sold. The land and buildings are taken to be separate assets, as the former is pre-CGT and the latter is post-CGT. Depending on how many of the Statham factors apply, the taxpayer can be assessed on the whole profit or only the capital gain from the sale of the building. Thank you for watching. This has been a very interesting assignment to undertake, and I hope you have learned something from my case note and this supplementary video presentation. Enjoy the rest of your day.